Welcome to the series 7 Top-Off Exam Preparation course. This introductory chapter establishes the foundational framework for your success by deconstructing the structure and regulatory expectations of the exam. This content is for informational and entertainment purposes only and does not constitute financial, legal, or tax advice. Always consult a qualified professional before making financial or legal decisions. This is an unofficial, independently produced course and study guide. It is not affiliated with, endorsed by, or connected to FINRA, the SEC, or any other regulatory body or exam provider in any way. All trademarks belong to their respective owners. If you are committed to advancing your career in the financial services industry, this course acts as your primary roadmap toward earning the General Securities Representative qualification. You have already completed the prerequisite Securities Industry Essentials examination, which signifies your readiness to bridge the gap between general knowledge and the specific, high-stakes regulatory requirements of the Series 7. We will methodically explore the intricacies of equity securities, debt instruments, and complex derivative strategies, ensuring you possess the technical proficiency required to function in a professional environment. Our curriculum is specifically designed to strip away the noise and focus exclusively on the high-probability topics that FINRA prioritizes in its assessment. By the end of this journey, you will be equipped to analyze investment products, navigate complex suitability rules, and uphold the highest standards of regulatory compliance mandated by the SEC and FINRA. The Series 7 Top-Off exam is a rigorous 3-hour and 45-minute assessment consisting of 125 multiple-choice questions, which requires a passing score of 72%. You should view this exam not merely as a test of memorization, but as an evaluation of your ability to apply regulatory standards to real-world scenarios across 4 primary job functions. These functions include seeking new business, evaluating customer profiles, providing investment information, and executing orders. The most critical component of the examination is the third function, which covers the provision of investment information and accounts for approximately 73 of the 125 questions. Because such a significant portion of your score depends on this single area, we will dedicate substantial time to mastering products like municipal bonds, options, and investment companies, all while ensuring you understand the legal responsibilities inherent in your role. Efficiency in your study methodology is paramount, as the breadth of material is vast, ranging from retirement accounts and ERISA standards to the intricacies of margin accounts and trade settlement protocols. We will adopt a systematic approach to each module, focusing on how different asset classes, such as U.S. government securities and money market instruments, fit within the broader regulatory framework. You must cultivate a deep understanding of prohibited practices and ethical conduct, as these concepts often serve as a check on your professional judgment when dealing with clients. Practice testing will remain an integral part of your routine to help you become comfortable with the timing constraints and the specific phrasing used in the actual exam environment. By focusing on the logic behind the rules rather than rote memorization, you will find it significantly easier to navigate the complexities of retail media rules and broker-dealer registration requirements. Consistency is the most important factor in your preparation for this certification, so remain engaged in the process until our next meeting. Welcome to this fundamental module where we will dissect the core mechanics of equity securities and the ownership rights that define them. This section is designed to provide you with a rigorous understanding of the instruments that form the backbone of the Series 7 examination. Common stock represents a fundamental unit of ownership in a corporation, granting the holder a proportionate claim on assets and earnings. When you acquire common stock, you are receiving voting rights that can be exercised either through statutory or cumulative methods. In a statutory voting system, a shareholder is permitted 1 vote per share for each director position, which tend to favor major shareholders by limiting the concentration of minority influence. Conversely, cumulative voting allows a shareholder to aggregate their total votes and allocate them as they see fit, frequently increasing the ability of minority shareholders to influence corporate board elections. Beyond voting, investors often use proxy voting to authorize a third party to cast their votes on their behalf, a necessity for dispersed retail ownership. You must also understand the concept of preemptive rights, which give existing shareholders the authority to maintain their proportional interest in the firm before new shares are offered to the public. If a company fails, these owners are last in line, as they possess only a residual claim on assets once all creditors and preferred shareholders have been satisfied. Preferred stock occupies a unique position in the capital structure, often exhibiting traits of both debt and equity instruments. A key feature of many preferred issues is the cumulative provision, which ensures that any missed dividend payments must be paid out to holders before common shareholders receive any distributions. If a stock is designated as participating, the holders are entitled to receive additional dividends if the company exceeds specific earnings benchmarks, although this is relatively rare in contemporary markets. Many companies issue convertible preferred stock, providing the shareholder the option to transform their holdings into a predetermined number of common shares, thus capturing potential equity upside. Conversely, callable preferred stock grants the issuer the right to repurchase the shares at a set price, which usually happens when interest rates fall and the company can refinance at a lower cost. These features collectively alter the risk-adjusted return profile of the security and directly impact its valuation on the secondary market. The mechanics of dividend distribution follow a rigid chronological sequence dictated by regulatory requirements and exchange processes. The board of directors initiates this cycle on the declaration date, which is the day the company officially announces the dividend amount and the timeline for payment. Next comes the ex-dividend date, which is now generally set one business day prior to the record date, ensuring that only those who own the shares before this point are entitled to the current dividend. On the record date, the corporation determines exactly which shareholders are on the books and scheduled to receive the payout. Finally, the payable date marks the moment funds are actually transferred from the corporate account to the shareholders of record. Understanding this one timeline is critical, as failing to execute a trade by the appropriate deadline results in the forfeiture of the dividend to the seller. Investment profiles for equity securities are typically delineated by their economic purpose and historical performance characteristics. Blue-chip stocks refer to shares of large, well-established corporations with a track record of stable earnings and consistent dividend payments. Growth stocks, in contrast, are issued by firms expected to expand at an above-average rate compared to the broader market, often reinvesting all profits back into the company rather than paying dividends. Income stocks are the preferred vehicle for investors seeking steady cash flow, as these companies prioritize dividends over capital appreciation. Defensive stocks characterize companies that remain relatively immune to economic cycles, providing essential goods or services that individuals continue to purchase regardless of the broader financial climate. Treasury stock, which represents shares previously issued and subsequently repurchased by the issuer, is held in the corporate treasury and does not carry voting rights or receive dividends, effectively reducing the total number of shares outstanding and increasing earnings per share. Foreign investing introduces nuances such as American depositary receipts, which allow domestic investors to trade interests in foreign corporations on local exchanges. These receipts function similarly to domestic stocks, but carry the added complexity of currency risk, as the value of the underlying foreign asset may fluctuate against the strength of the domestic currency. Warrants represent another equity-related derivative, giving the holder the right to purchase shares from the company at a specifically fixed price over an extended period. Unlike rights offerings, which are short-term instruments issued to existing shareholders to maintain equity stakes, warrants are often attached to bond offerings as a sweetener to lower interest costs. It is essential to distinguish between the intrinsic value of these instruments, which is the difference between the market price and the exercise price, and their time value, which reflects the market expectation of value growth before expiration. See you in the next session. Welcome back. Today we begin our deep dive into corporate debt and bond fundamentals. We will cover the mechanics of corporate borrowing, interest rate risk, and the hierarchy of creditor claims. To understand corporate debt, we must start with the foundational terminology that governs all fixed income securities. A bond represents a loan from the investor to the corporation, typically issued with a par value of $1,000, which is the amount repaid at maturity. The coupon rate represents the annual interest payment, fixed as a percentage of that par value, though the actual price of the bond fluctuates based on market conditions. Maturity structures dictate how the principal is returned. Term bonds mature in a single lump sum, while serial bonds are retired incrementally according to a predefined schedule. A balloon maturity occurs when a significant portion of the principal remains due at the final date, following smaller earlier payments. These structures are designed to match the corporation's cash flow needs with its liability obligations, and understanding them is essential for assessing credit risk. Pricing mechanics add another layer of complexity, as bonds trade at a premium if the market interest rate is lower than the coupon, or at a discount if the market rate is higher. We measure these fluctuations in basis points, where 1 basis point is equal to 0.01%, providing the precision needed for bond trading. Yield calculations are the primary tools used to determine the relative value of a bond beyond its nominal coupon. The nominal yield remains the fixed interest rate set at issuance, but current yield provides a more accurate snapshot by dividing the annual interest payment by the current market price. When we look at the long-term perspective, yield to maturity represents the total return an investor expects if the bond is held until its final due date, accounting for both interest and any capital gain or loss. Yield to call becomes relevant when an issuer has the right to redeem the debt early, often occurring when market interest rates fall and the corporation seeks to refinance its debt at lower costs. There is a fundamental inverse relationship between bond prices and interest rates. As market rates rise, the present value of future coupon payments decreases, causing the price of existing bonds to fall. This inverse sensitivity is the cornerstone of interest rate risk management in a fixed income portfolio. By calculating these various yields, an investor can make empirical comparisons between different debt instruments despite variations in their coupons and pricing. The security structure of a bond defines the level of legal protection afforded to the lender in the event of a default. Secure debt is backed by specific collateral, such as mortgage bonds, which are secured by real estate, or equipment trust certificates where the underlying machinery serves as the recovery asset for investors. Conversely, debentures are unsecured debt instruments backed only by the issuing corporation's full faith and credit, making them riskier and typically carrying higher interest rates to compensate. Subordinated debt occupies a lower rung in the capital structure, meaning these creditors only receive payment after the senior debt holders have been fully compensated during a liquidation process. This hierarchy is critical during bankruptcy, as the absolute priority rule dictates that secured creditors take precedence over subordinated debentures and eventually equity holders. Convertible bonds add a hybrid dimension by allowing the holder to swap the bond for a predetermined number of shares of common stock, which introduces the concept of parity. Parity price is the theoretical market value, where the conversion feature equals the current market price of the underlying equity, serving as an arbitrage opportunity if the bond trades below that value. Credit rating agencies, primarily Moody's and Standard & Poor's, provide the market with an assessment of an issuer's ability to meet its financial obligations. Securities carrying investment-grade ratings represent lower default risks and are suitable for conservative portfolios, whereas high-yield or junk bonds offer higher coupons to offset the significantly elevated risk of default. These ratings are not static and are frequently updated based on the issuing corporation's financial leverage, cash flow stability, and broader industry outlooks. Evaluating these ratings allows investors to calibrate their expectations regarding both income potential and the probability of principal loss. Understanding the relationship between these ratings and the cost of debt is vital for any professional involved in fixed income analysis. By synthesizing these elements, we can construct comprehensive assessments of corporate debt instruments that align with specific risk tolerances and objectives. I look forward to our next session. Welcome to our deep dive into municipal bonds and their unique tax implications, where we will examine the mechanics of public sector debt. This chapter provides the essential framework for understanding how states and municipalities finance their infrastructure and operations through tax-advantaged securities. Municipal bonds are primary debt instruments issued by states, cities, and counties to fund public projects, but the landscape is bifurcated into general obligation bonds and revenue bonds. General obligation bonds, often referred to as GOs, are backed by the taxing power of the issuer, specifically through ad valorem taxes on real estate and property. Governments are limited by statutory debt limits, which are legal constraints meant to protect taxpayers from excessive borrowing that could lead to insolvency. Because these bonds rely on public taxation, they often require voter approval before issuance, creating a layer of transparency and democratic oversight not always present in other forms of debt issuance. When a municipality fails to meet its obligations, it may be forced to raise tax rates or liquidate assets to satisfy creditors, representing a significant commitment of the local government's financial resources. Understanding these limits is critical because they dictate the credit quality and risk profile of the GO bond in question. You should view these securities as a marriage between public policy goals and the fiduciary requirements of the bond market. Revenue bonds, by contrast, are not supported by the power to tax, but are instead serviced by the specific revenues generated by the project they fund. Examples include toll roads, airports, or municipal utility systems, where user fees provide the steady cash flow required to pay interest and principal. Before these bonds reach the market, a feasibility study is conducted by an independent consultant to project expected usage and income levels to ensure the debt can be serviced without issue. Industrial development revenue bonds represent a specialized subset used to provide financing for private corporations to build facilities, although these often carry different risks. Investors must be aware that some of these bonds may trigger alternative minimum tax consequences, which reduces the effective benefit of their federal tax-exempt status. Unlike GO bonds, revenue bonds are generally not subject to statutory debt limits because they do not rely on local taxpayer money for repayment. This makes them a distinct asset class that fluctuates based on economic demand for the underlying services provided. Municipal notes are short-term debt instruments utilized by issuers to handle temporary cash flow fluctuations, and they're typically issued for periods of less than 1 year. Tax anticipation notes, or TANs, are expected to be paid off when the issuer receives anticipated tax collections, acting as a bridge until revenues arrive. Revenue anticipation notes, or RANs, operate similarly but are tied to expected future income from sources other than taxes, such as federal grants or project revenues. Bond anticipation notes, or BANs, provide temporary financing for a project until a long-term bond issue can be successfully brought to market to replace them. These instruments are highly liquid and generally provide a lower yield than long-term bonds due to their shorter maturity and lower interest rate risk. They serve as an essential tool for municipal treasurers who need to maintain balanced budgets despite the timing differences between expenditures and revenue receipts. When analyzing these notes, focus on the credibility of the revenue or tax source being pledged for repayment. To evaluate the true value of a tax-exempt municipal bond compared to a taxable corporate bond, we use the tax-equivalent yield formula. This calculation allows you to normalize different yields by accounting for the marginal tax bracket of the investor, who needs to know if the tax-free status compensates for a lower nominal rate. The formula takes the municipal yield and divides it by the result of 1 minus the investor's tax rate, providing the taxable yield required to achieve the same net return. For example, if an investor in a 35% tax bracket considers a 4% municipal bond, you would divide 4% by 0.65 to determine the equivalent taxable bond yield. This comparison is the bedrock of municipal bond suitability analysis because it helps determine whether the tax benefit is actually providing a superior net of tax return. Always remember that while federal interest on most municipal bonds is exempt, state and local taxes may still apply, depending on the residency of the bondholder. The primary market for municipalities functions through two primary methods: competitive bidding and negotiated underwriting. In a competitive sale, the issuer publishes a notice of sale and underwriters submit sealed bids to offer the lowest interest cost, which favors the issuer's effort to minimize borrowing costs. Conversely, a negotiated sale involves the issuer selecting an underwriter directly to structure the issue, price the bonds, and distribute them to the public in a collaborative process. Syndicate structures are formed to spread the underwriting risk among multiple firms, with a lead manager coordinating the group's efforts and the allocation of the bonds. Central to this process is the official statement, which serves as the equivalent of a prospectus for corporate securities, providing comprehensive detail on the issuer's finances and the project scope. The legal opinion, delivered by independent bond counsel, is perhaps the most critical document because it confirms the legal validity of the issue and verifies its federal tax-exempt status. Without a clean legal opinion, the issue would be virtually impossible to market, as it validates that the issuance complies with all relevant state and federal statutes. Regulatory compliance in the municipal market is strictly governed by the Municipal Securities Rulemaking Board, or MSRB, through rules such as G37 and G17. Rule G37 prohibits municipal dealers from engaging in municipal securities business with an issuer for 2 years if they have made political contributions to officials of that issuer. This rule is designed to prevent pay-to-play schemes where firms might win underwriting contracts by effectively buying influence with local government officials. Rule G17 focuses on the principle of fair dealing, mandating that all municipal dealers provide transparent information and treat all customers with honesty and integrity in every transaction. It essentially codifies the industry's standard that professionals must prioritize the interest of the market and the client over personal gain. By adhering to these rules, market participants maintain the integrity of the municipal bond market, which is essential for public trust in government-sponsored debt, and failure to comply can lead to significant disciplinary action. These regulations exist to ensure that the process of financing public infrastructure remains neutral, competitive, and ultimately focused on the needs of the issuer and the investors. I will catch you in the next lecture. Hello. Today we are diving into the world of United States government and agency securities to understand their role in a balanced investment portfolio. This chapter will provide you with the essential technical knowledge required to distinguish between various Treasury instruments and agency-backed obligations. When we examine marketable Treasury securities, we begin with Treasury bills, which are short-term instruments issued at a discount to par value and mature in 1 year or less. Unlike longer-term securities, T-bills do not pay periodic interest, but rather provide a return through the difference between the purchase price and the maturity value. Conversely, Treasury notes and Treasury bonds represent longer-term debt obligations that make semi-annual interest payments to the holder. An important technical detail to memorize for the exam is the pricing convention for these notes and bonds, which are quoted in 30 seconds of a point. If you see a quote of 98.16, it does not mean 98.16%, but rather 98 and 16/32% of par, which effectively dictates the market price paid by the investor. Understanding this fractional division is fundamental to calculating the actual dollar cost of these securities when executing trades in an exam scenario. To address specific economic concerns, the Treasury offers specialized products like Treasury inflation-protected securities, commonly known as TIPS. The principal value of TIPS is adjusted semi-annually based on changes in the Consumer Price Index, which ensures that the investor's purchasing power is shielded from the erosive effects of inflation. While the principal reflects these adjustments, the fixed interest rate is applied to the inflation-adjusted principal, meaning interest payments grow alongside the base value. Another niche instrument is the Treasury strips, which stand for separate trading of registered interest and principal securities. These are essentially zero-coupon bonds created by stripping interest coupons from the underlying principal of a Treasury bond. Because they are sold at a deep discount and pay no interest until maturity, they are particularly attractive for investors looking to lock in specific future cash flows without the reinvestment risk associated with periodic coupon payments. Agency issues represent a different category of debt, where the issuing entity is often a government-sponsored enterprise rather than the U.S. Treasury itself. The Government National Mortgage Association, or GNMA, holds a unique distinction because its mortgage-backed securities are fully backed by the full faith and credit of the United States government. In contrast, entities like the Federal National Mortgage Association and the Federal Home Loan Mortgage Corporation are government-sponsored enterprises, meaning their issues carry an implied backing but lack the direct guarantee of the federal government. When dealing with mortgage-backed securities, you must be familiar with the concepts of prepayment risk and extension risk. Prepayment risk occurs when homeowners pay off their mortgages early, often during low-interest rate environments, forcing the investor to reinvest their capital at lower prevailing rates. Extension risk is the opposite phenomenon, occurring when rising interest rates cause homeowners to hold their mortgages longer, thereby slowing the return of principal to the investor. Collateralized mortgage obligations introduce a layer of complexity by segmenting mortgage-backed security pools into tranches, which allows issuers to provide varying levels of maturity and risk profiles. A planned amortization class tranche is designed to provide more predictable cash flows by absorbing the volatility of prepayments within specific windows. Targeted amortization class tranches offer similar structure, but with less protection against prepayment volatility than their PAC counterparts. The Z tranche is essentially an accrual bond that receives no cash payments until all preceding tranches are retired, making it a longer-term zero-coupon style instrument. Regarding tax implications, all interest income from federal Treasury obligations is subject to federal income tax, while remaining exempt from state and local taxes. However, interest from agency securities is generally subject to federal, state, and local taxation, with very few specific exceptions that you should note for your testing purposes. The primary dealer system serves as the central pillar of the market for government securities by acting as the main counterparties for the Federal Reserve. When the Federal Reserve engages in open market operations, it buys or sells these Treasury securities to regulate the supply of money and influence short-term interest rates. Buying securities adds reserves to the banking system, which typically lowers interest rates and stimulates economic activity, whereas selling securities drains reserves and exerts upward pressure on rates. These operations are not merely academic concepts, but are the primary mechanism by which the Federal Reserve executes monetary policy. As an aspiring financial professional, recognizing how these actions shift the price of Treasury bonds is crucial, as the inverse relationship between interest rates and bond prices remains a cornerstone of fixed income analysis. You must be able to correlate these macroeconomic moves with the price behavior of the securities discussed throughout this lecture. See you in the next lecture. Welcome to our deep dive into the foundational instruments of the money market. In this chapter, we will explore the short-term credit mechanisms that drive liquidity in the global financial system. Money market instruments are sophisticated short-term debt securities that typically mature in 1 year or less. Their primary purpose is to provide highly liquid, low-risk alternatives for corporate and institutional cash management. When we talk about these instruments, we are discussing the backbone of capital preservation strategies rather than speculative growth vehicles. Because their maturity is short, these instruments are relatively insensitive to long-term interest rate fluctuations, though they remain sensitive to broad changes in benchmark rates. Understanding these securities is essential because they represent the first line of defense in a conservative portfolio, ensuring that immediate cash obligations can be met without liquidating long-term equity or bond positions. Investors turn to these instruments when they prioritize the safety of principal above all else. Commercial paper is essentially an unsecured promissory note issued by corporations to cover short-term liabilities like payroll or inventory costs. To qualify for specific registration exemptions under the Securities Act of 1933, commercial paper must have a maturity of 270 days or less. This specific constraint is crucial for the exam, as it highlights the regulatory boundary between short-term obligations and more permanent capital raising efforts. These notes are almost always issued at a discount to their par value, meaning the return is the difference between the purchase price and the maturity payment. While they're usually considered high quality, they do carry credit risk, which is why they are typically issued by entities with strong credit ratings. If the issuing corporation defaults, the holder has little recourse compared to secured debt holders, which is a detail that informs the pricing and yield expectations of the product. Bankers' acceptances, or BAs, serve a very specific function in the world of international trade. Imagine a scenario where a domestic company imports goods from a foreign supplier. The exporter may not trust the creditworthiness of the importer. A banker's acceptance acts as a time draft guaranteed by a commercial bank, essentially substituting the bank's credit for the importer's credit. This allows the exporter to receive payment immediately by selling the draft at a discount in the secondary market. These instruments are self-liquidating because they are backed by the underlying goods being shipped, which provides a tangible layer of security. They are considered safe, high-quality instruments that facilitate the flow of global commerce while offering a predictable income stream for institutional investors who hold them until maturity. Negotiable certificates of deposit, often called jumbo CDs, represent another pillar of the money market. Unlike the small, non-negotiable CDs individual retail investors might hold at their local bank, these are issued in amounts of at least $100,000, though they are frequently traded in much larger denominations. They are negotiable, which means they can be sold in the secondary market before reaching maturity, providing the liquidity that a standard bank certificate lacks. The interest rates on these jumbos are influenced by current market conditions, and they are unsecured obligations of the issuing bank. Because they are backed by the credit of the bank, their safety generally rests on the financial health of the issuing institution, making them a common choice for investors seeking a moderate yield with short-term principal accessibility. Repurchase agreements, or repos, involve one party selling securities to another with a formal agreement to buy them back at a specified price and date. From the perspective of the dealer, it is a repo. From the investor's perspective, it is a reverse repo. Effectively, this is a collateralized short-term loan where the underlying assets, usually treasury securities, serve as the security for the cash provided. The difference between the sale price and the repurchase price represents the interest earned by the lender. These arrangements are vital for the smooth functioning of the overnight market, allowing firms to manage their temporary cash balances efficiently. The risk here is primarily related to the counterparty, though the collateralization of the transaction drastically mitigates the potential for loss if the borrower fails to perform. We must distinguish between several key interest rate benchmarks to understand the macro environment of money markets. The federal funds rate is the rate that banks charge each other for overnight loans to maintain their mandatory reserve requirements and is the most sensitive indicator of Federal Reserve policy. The discount rate is the rate the Federal Reserve charges commercial banks for direct loans at the discount window, serving as a signal for the central bank's stance on monetary policy. Meanwhile, the prime rate is the benchmark rate that commercial banks charge their most creditworthy corporate customers. It is important to note the ongoing transition from LIBOR to SOFR, as the industry moves toward more robust, transaction-based benchmarks that better reflect the realities of the current repo markets. Understanding these rates is necessary for assessing how different money market instruments move in relation to one another. Maintaining capital in money market instruments is not without its specific set of risks despite the focus on preservation. The most prominent hazard is purchasing power risk or inflation risk. Because these instruments offer low interest rates, they may fail to keep pace with the cost of living over extended periods. If your client intends to hold cash equivalents for a multi-year horizon, they may inadvertently erode the value of their capital in real terms. Furthermore, although default risk is generally low, liquidity risk can manifest during times of extreme market stress, where the secondary market for certain instruments may dry up unexpectedly. You must always assess the suitability of these products against a client's actual need for liquidity versus their long-term growth objectives. Balancing these factors is a fundamental competency for any professional managing a client portfolio. See you in the next lecture. Welcome to this chapter on investment companies and managed products, where we will examine the regulatory structures and classifications governing pooled investment vehicles. You will gain a firm grasp of how mutual funds, ETFs, and specialized products like REITs function within the regulatory framework of the Investment Company Act of 1940. The Investment Company Act of 1940 serves as the foundational legislation for the industry, categorizing investment companies into three primary structures: face amount certificates, unit investment trusts, and management companies. Face amount certificates are debt securities where the issuer pays a fixed amount at a maturity date, while unit investment trusts operate with a fixed portfolio of securities that remain unchanged until the trust reaches its termination date. Management companies, by contrast, utilize professional investment advisors to manage portfolios actively or passively, and these are subdivided into open-end and closed-end structures. An open-end fund, universally recognized as a mutual fund, continuously issues new shares and redeems them at their next calculated net asset value. Conversely, a closed-end fund conducts a single initial public offering, after which its shares trade on secondary markets based on supply and demand rather than their underlying net asset value. This distinction is critical because closed-end shares can trade at a premium or a discount to their net asset value, whereas mutual funds always transact at the calculated net asset value plus any applicable sales charges. Understanding mutual fund share classes is essential for advising clients effectively, as these structures dictate the fee arrangements and compensation models for broker-dealers. Class A shares typically impose a front-end load, which is a sales charge deducted from the initial investment, making them more cost-effective for long-term holders due to lower annual operating expenses. Class B shares feature a back-end load known as a contingent deferred sales charge that diminishes over time, eventually converting to Class A shares if held long enough, though they carry higher ongoing expenses. Class C shares, often called level load shares, carry a continuous annual fee and are generally unsuitable for long-term investors aiming to minimize total cost of ownership. These products often incorporate 12b-1 fees, which are annual charges levied against the fund's assets to cover marketing and distribution expenses, provided they are explicitly authorized by the board and shareholders. Advisors must also be proficient in discussing breakpoints, where the sales charge is reduced when a client commits a larger dollar amount to the fund. These breakpoints can be reached through a letter of intent or via rights of accumulation, which aggregate the value of the current holding with other related accounts to reduce the sales load. Exchange-traded funds have transformed the landscape through their structural tax efficiency and the ability to trade intraday, like common stocks. Unlike mutual funds, which trigger capital gains distributions when they sell securities within the portfolio, ETFs typically utilize an in-kind creation and redemption process with authorized participants to minimize taxable events. This mechanism allows the underlying portfolio of an ETF to remain largely shielded from the tax consequences that occur when mutual fund shareholders redeem their holdings en masse. Real estate investment trusts, or REITs, offer a separate dimension by allowing individuals to invest in large-scale, income-producing real estate portfolios. To operate as an entity that avoids taxation at the corporate level, a REIT must adhere to the 75-75-90 rule, requiring that at least 75% of its assets be in real estate. 75% of its gross income must derive from real estate sources, and it must distribute at least 90% of its taxable income to shareholders annually. These entities are not mutual funds under the 1940 Act, yet they're ubiquitous in portfolios seeking income through diversified real estate exposure. Hedge funds, direct participation programs, and private equity investments operate with significantly different regulatory profiles compared to the highly standardized registered investment companies we have just discussed. These vehicles are generally restricted to accredited or institutional investors and lack the daily liquidity associated with mutual funds or ETFs. Direct participation programs allow investors to participate directly in the cash flow and tax benefits of the underlying business, often structured as limited partnerships, which complicates their liquidity and transferability. Private equity funds pool capital from investors to acquire or restructure companies, typically locking up capital for several years during the investment life cycle as they work to create value before an exit. Hedge funds employ more aggressive strategies, including short selling, leverage, and derivatives, which necessitate a higher degree of risk tolerance and lower liquidity requirements from the investor. Because these assets are not as transparently priced or regulated as open-end funds, the burden of suitability is much higher for the representative. You must ensure that the investor understands the inherent lack of marketability and the specific risk profile of these alternative investments before any commitment is made. See you in the next lecture. Welcome back. Let's begin our exploration of basic call and put strategies by defining how investors leverage directional views through options. In this chapter, we will master the mechanics of long and short positions to navigate various market conditions effectively. A long call represents a bullish position where the investor purchases the right to buy an underlying security at a specified strike price. This strategy provides leverage because you control a significant amount of the underlying asset for a relatively small premium outlay. The maximum risk for a long call is limited to the premium paid, while the potential gain is theoretically unlimited as the stock price rises. The break-even point is calculated by adding the premium paid to the strike price of the call option. For example, if you buy a call with a strike price of $50 for a premium of $3, your break-even point is $53. Investors typically employ this strategy when they expect the stock price to appreciate significantly within a specific time frame. Because the contract has an expiration date, time decay is a factor that works against the holder of the option. If the stock remains below the strike price at expiration, the option expires worthless and the investor loses the entire amount of the initial premium. Selling a call or writing a call creates a position that is bearish or neutral, depending on whether the seller owns the underlying stock. A covered call occurs when the writer also holds the underlying stock, effectively capping their upside potential in exchange for immediate income from the premium received. Conversely, selling a naked call or an uncovered call involves selling an option without owning the underlying security. This carries unlimited risk because the seller is obligated to purchase the stock at the current market price, which could theoretically rise to infinity, to deliver it to the buyer at the strike price. Regulations require that an investor selling naked calls must have substantial margin to account for this significant risk. The maximum gain for a call writer is limited to the premium collected, while the maximum loss is theoretically unlimited for naked positions. In a covered call scenario, the maximum loss is realized if the stock price drops to zero, though the premium received provides a minor offset to the loss. A long put is a bear strategy used for speculation or to provide downside protection for a stock portfolio. When an investor buys a put, they acquire the right to sell the underlying security at a fixed strike price, effectively establishing a floor for their equity position. This is commonly known as a protective put, and it is a classic form of hedging against market volatility or a downturn in a specific stock. The maximum loss for a long put is limited to the premium paid, which occurs if the stock remains above the strike price at expiration. The maximum gain occurs if the stock price drops to zero, where the profit is the strike price minus the premium paid. The break-even point for a long put is calculated by subtracting the premium paid from the strike price of the option contract. If the stock price stays above the strike price, the put expires worthless, and the cost of the premium is fully realized as a loss. Writing a put or selling a put allows an investor to generate income while potentially acquiring a stock at a price lower than its current market value. This is considered a bullish or neutral strategy because the writer benefits if the stock price stays above the strike price or rises. If the stock price falls below the strike price at expiration, the seller is obligated to buy the stock at the strike price, which is why a short put writer must maintain sufficient collateral or cash in their margin account. The maximum gain for a short put is limited to the premium received when the option was sold initially. The maximum loss is substantial, occurring if the stock price drops all the way to zero, forcing the investor to buy a worthless asset at the agreed-upon strike price minus the premium already collected. Break-even for a short put is determined by subtracting the premium from the strike price, representing the point where the income from the premium covers the loss on the stock purchase. Margin requirements for these positions are governed by FINRA and federal regulations to protect the integrity of the market. Long options always require 100% of the premium to be paid in cash, as they cannot be purchased on margin. For short options, the broker-dealer must calculate the equity requirement based on the current market value of the underlying security and the type of option involved. Selling naked calls, for instance, requires significant capital because of the unlimited risk profile mentioned previously. Naked puts also require margin, but the requirement is generally lower than for naked calls because the potential loss is capped at the strike price of the stock. Understanding these requirements is essential for maintaining compliance and ensuring that your strategic planning accounts for the collateral demands of the firm. Proper risk management through margin oversight prevents a margin call, which could force an investor to liquidate their position at an unfavorable time. See you in the next session. Welcome back. In this lesson, we navigate the complex world of advanced option strategies, focusing on multi-leg positions like spreads, straddles, and combinations to master the risk-reward profiles required for the Series 7. Vertical spreads, also known as price spreads, involve buying and selling options of the same class, either all calls or all puts, with the same expiration date but different strike prices. When you enter a bull call spread or a bear put spread by paying a net amount, you are establishing a debit spread, which necessitates that the price movement works in your favor to exceed the cost of the premiums paid. Conversely, credit spreads occur when you receive a net premium, meaning you are essentially betting that the options will expire worthless or that the spread will narrow, allowing you to keep the initial credit as profit. Understanding whether a position is a debit or credit is fundamental because it dictates your maximum profit and loss potential, which are always constrained in these strategies. For example, in a bull call spread, your maximum gain is the difference between the strike prices minus the net debit, whereas your maximum loss is strictly limited to the net debit paid. Remembering that debit spreads are generally about hoping the spread widens while credit spreads rely on the spread narrowing provides a reliable mental model for any exam question involving these structures. Horizontal spreads, often called calendar or time spreads, involve options with different expiration dates but identical strike prices, while diagonal spreads combine differences in both time and price. These strategies are more nuanced because they depend heavily on the passage of time, essentially trading the rate of theta decay between the near-term and long-term contracts. When managing a diagonal spread, you are balancing the directional view of the underlying security with the reality that the two legs of the trade will react differently to changes in volatility and time. Calculating the break-even points for these positions requires accounting for the cost basis of the entire multi-leg entry, as you must offset the net outlay or factor in the net receipt against the possible exit value of each leg. Often, candidates get tripped up overestimating the delta of the further out contract, so it is necessary to remain disciplined in viewing the total position as a single economic unit. Because these strategies are rarely used for pure speculation, they're usually categorized under income generation or hedging, which influences how you should approach their risk assessment on the exam. Straddles represent a departure from direct directional bets, opting instead for a position on the volatility of the underlying asset without committing to a specific price movement. A long straddle, where you purchase both a call and a put at the same strike and expiration, is profitable only if the stock price moves significantly in either direction, covering the combined cost of both premiums. This requires a sharp increase in realized volatility, which makes it a classic strategy for anticipating major company news like earnings reports or regulatory announcements. On the other hand, a short straddle involves selling both options, where your objective is for the stock to remain stable and trade sideways, allowing you to collect the maximum premium as both contracts expire worthless. Because the short straddle exposes you to theoretically unlimited risk on the call side and substantial risk on the put side, it is an aggressive strategy that is rarely suitable for conservative investors. Recognizing the intended environment for these strategies, either high volatility expectations or price compression scenarios, is the most reliable way to identify the correct answer in complex scenarios. When we transition to combinations, we are typically looking at positions like a strangle, which is similar to a straddle but utilizes different strike prices to lower the cost of entry at the expense of a wider break-even requirement. These multi-leg positions force us to evaluate the impact of various corporate actions, particularly dividends and stock splits, on our open contracts. It is vital to remember that while the Options Clearing Corporation makes adjustments for stock splits, these adjustments often result in non-standard contracts, changing the deliverable amount of shares or the strike price. Dividends do not cause an automatic adjustment to option strike prices unless they are significant or treated as a special distribution, which is a nuance frequently tested to see if you can differentiate between routine price changes and contract modifications. When you analyze a multi-leg position, always verify if it is a net debit or net credit, as this simple categorization will immediately indicate whether the strategy is seeking growth or income. By keeping the mechanics of debit and credit front and center, you eliminate the confusion that often arises when dealing with 4 or more legs in a single trade. See you in the next lecture. Welcome to our deep dive into index and yield-based options, where we will examine how these derivatives allow for hedging against systemic risk. You will master the mechanics of these instruments, ensuring you have the precision required to tackle the most complex Series 7 questions. When we transition from equity options to index options, the most fundamental shift involves the underlying asset and the nature of settlement. Equity options involve the delivery of actual shares, but index options are purely financial instruments settled in cash. Because an index is a statistical construct rather than a physical grouping of shares, it is impossible to exercise a call or put and receive the basket of stocks themselves. Instead, if an index option is exercised, the writer pays the holder the difference between the strike price and the current index value in cash. This multiplier is standard at $100, just like equity options, which keeps your mental math consistent across different instrument types. The settlement process is also expedited, typically occurring on the next business day, which reflects the reduced operational complexity of transferring cash compared to securities. Index options are further classified as either broad-based or narrow-based, a distinction that carries significant weight in suitability and diversification. A broad-based index mirrors the performance of the entire market or a major sector, such as the S&P 500 or the Dow Jones Industrial Average. Because these indexes contain too many individual components to be easily manipulated, they're treated differently by regulators. Conversely, a narrow-based index focuses on a specific subsector, like technology or gold mining, which makes them more susceptible to the volatility of a few specific companies. From an examination perspective, keep in mind that the VIX, or volatility index, often moves in an inverse correlation to the broader stock market. When market fear spikes, the VIX typically rises, making it a powerful tool for sophisticated investors who want to hedge against sudden, systemic market corrections rather than individual stock decline. Yield-based options represent a departure from price-based derivatives because they are directly tied to the yields of United States Treasury securities. Rather than focusing on the price of the bond itself, these options fluctuate based on the interest rates or yields of T-bills, T-notes, or T-bonds. These are essentially bets on the direction of interest rates, and like index options, they rely entirely on cash settlement upon expiration. If you believe interest rates will rise, you might purchase a call option on a yield, whereas if you anticipate a decline in rates, you would look at the put side. While they sound complex, they follow the same logic as other options where the premium paid reflects the expectation of movement against the strike yield, and the settlement is determined by the specific yield levels at the close of trading. Hedging systemic risk is perhaps the primary practical application for index options in a professional portfolio management scenario. If a manager holds a large, diversified long position in stocks, they cannot easily sell all their holdings when they fear a market-wide downturn. By purchasing put options on a broad-based index, they effectively buy an insurance policy that pays out if the broader market falls, regardless of how their specific stocks perform. This is the definition of managing for systematic risks, which are the risks that cannot be diversified away through stock selection alone. Calculating the profit or loss here is straightforward. You take the difference between the closing index value and the strike price, multiply it by 100, and then subtract the premium paid for the position. Finally, we must address the tax treatment, as index options under Section 1256 are subject to specific IRS rules that differ from standard equity options. Most index options are classified as Section 1256 contracts, which benefit from the favorable 60/40th tax rule. This means that 60% of any capital gain or loss is treated as long-term, and 40% is treated as short-term, regardless of how long you actually held the position. This creates a predictable and generally advantageous tax outcome for active traders who frequently use these instruments. Expiration cycles for these options are also quite uniform, ensuring that you can construct long-term hedging strategies with fixed dates. Understanding these characteristics is essential for moving beyond basic memorization and towards a structural understanding of how these derivatives function in a regulated environment. See you in the next session. Welcome back to our discussion on derivatives, where we will now focus on the specialized area of foreign currency options and how they serve as a critical hedging tool for international trade. This chapter will provide you with the essential framework to master foreign currency risk management from a Series 7 perspective. When we approach foreign currency options, the first conceptual hurdle is understanding the EPIC mnemonic, which stands for exporters by puts and importers by calls. An American company that exports goods to Europe expects to receive payments in euros in the future, which exposes them to the risk that the euro might depreciate against the US dollar. By purchasing a put option on the foreign currency, the exporter establishes a floor price, ensuring that even if the foreign currency weakens, they can sell it at the strike price determined today. Conversely, an American importer who must pay in a foreign currency faces the risk that the foreign currency will appreciate, making their obligation more expensive in dollar terms. An importer buys a call option on the foreign currency to lock in a maximum purchase price, effectively capping the cost of the goods they intend to import. This relationship is essentially an insurance policy against adverse fluctuations in exchange rates between the domestic and foreign currencies. The mechanics of these contracts follow standard option conventions, but with specific nuances regarding contract size and settlement that you must memorize for the exam. With the exception of the Japanese yen, which has a standard contract size of 1 million units. Most foreign currency option contracts represent 10,000 units of the underlying foreign currency. Unlike equity options, we might expect physical delivery of shares. Exercises for foreign currency options are settled in cash unless otherwise specified by the exchange rules. When a holder exercises an option, they receive a cash payment based on the difference between the strike price and the current spot exchange rate at the time of exercise. This cash settlement happens in US dollars, simplifying the process for businesses that are primarily interested in the financial hedge rather than the actual ownership of foreign banknotes. Understanding this cash settlement feature is crucial because it differentiates these instruments from traditional equity derivatives. Complexity often arises when candidates confuse the direction of the hedge, particularly when thinking about the value of the US dollar versus the foreign currency. You must maintain a strict perspective. You're always hedging the foreign currency itself, not the US dollar, even though the contract is denominated and settled in dollars. If you're an American exporter, you're long the foreign currency exposure, so a decline in that currency's value hurts your bottom line. Therefore, you buy a put to hedge that long exposure, exactly as you would buy a put on a stock you own to protect against a price decline. If you're an American importer, you're effectively short the foreign currency because you have an impending liability that requires you to eventually purchase that currency in the open market. By buying a call, you're creating a long position in the foreign currency that offset the inherent risk of the currency rising in cost before your payment date. The premium of a foreign currency option behaves much like an equity option premium, driven by intrinsic value and time value, but with the added layer of interest rate differentials. If the currency underlying the option is expected to appreciate, the call premiums will rise and the put premiums will fall, mirroring the volatility logic you have already studied. You should be prepared to identify the appropriate contract when presented with a client's specific trade profile, such as a company expecting to receive payments in Canadian dollars or a firm needing to settle invoices in British pounds. We evaluate risk profiles by asking if the client's cash flow is an inflow or an outflow relative to the foreign currency. An inflow, such as export revenue, creates long currency exposure requiring put protection, whereas an outflow, such as import expenses, creates short currency exposure requiring call protection. Keeping these mechanics aligned is the most effective way to solve any suitability or hedging question on the exam without getting tangled in the exchange rate arithmetic. I look forward to our next session where we will apply these hedging principles to new trading scenarios. Welcome to this chapter where we will examine the intricate tax consequences and regulatory frameworks governing options trading. We will cover technical compliance steps, assignment protocols, and the critical tax rules affecting your clients' portfolios. Understanding the tax implications of options begins with how they interact with existing stock positions. When an investor holds a long stock position for more than 1 year, they typically qualify for long-term capital gains treatment upon sale. However, buying a put option on that same stock can trigger a reset of this holding period. Essentially, if you purchase a put while holding stock short-term, the holding period for the stock is suspended. It starts over only after the put position is closed. This rule is designed to prevent investors from shielding short-term gains behind a hedge. Furthermore, the wash sale rule applies if an investor realizes a loss on an option or stock and purchases a substantially identical security within 30 days before or after the trade. For exercise contracts, the cost basis of the security is modified. If an investor exercises a call, the strike price plus the premium paid becomes the cost basis for the stock. If a put is exercised, the premium paid is subtracted from the strike price, effectively reducing the proceeds of the sale for tax calculation purposes. Expired options are treated as short-term capital gains or losses, regardless of the underlying security's holding period or the duration the option was held. Compliance revolves around the structured process of assignment and oversight. When a customer writes an option that is subsequently exercised, the Options Clearing Corporation, or OCC, manages the assignment process to member firms. The OCC utilizes a random selection model to allocate assignments to firms, ensuring that no specific firm is unfairly burdened. Once the member firm receives an assignment notice, it is internal policy that dictates how this is distributed among clients. The firm must use a systematic, non-discriminatory method such as first in, first out, or a random selection process, or any other method that the firm submits to the regulatory authority as fair and equitable. This is verified during audits to prevent preferential treatment of proprietary accounts over customer accounts. Every firm must appoint a registered options principal, or ROP, who is responsible for ensuring that all firm and customer activity strictly adheres to the stated rules. This individual oversees the approval of accounts, ensuring that the firm understands the financial situation and investment objectives of the client before allowing speculative trading to commence. The account approval process is a stringent regulatory requirement designed to protect both the firm and the retail investor. When a client expresses interest in options trading, the firm must collect specific financial data and establish a clear profile of their risk tolerance. Upon the initial approval of the account by the ROP, the client has 15 days to sign and return the standardized options agreement. This document serves as a legal acknowledgement that the client understands the risks involved in options, including the possibility of losing the entire investment. If this agreement is not returned within that 15-day window, the firm is obligated to restrict the account to closing transactions only. Furthermore, the firm must monitor position limits and exercise limits to ensure that large participants do not exert undue influence on the market. These limits restrict the number of contracts a client can hold or exercise within a 5-day period for a single class of options. These constraints are vital for maintaining orderly markets and preventing the concentration of derivative risk. Margin requirements represent the final layer of regulatory compliance for active options traders. Selling uncovered options, otherwise known as naked writing, carries significant financial risk. Therefore, the firm must require substantial equity in the margin account to cover potential losses. The specific margin rules vary depending on the strategy, such as spreads, where the risk is defined by the difference between the strike prices. When a client engages in a debit spread, they pay for the privilege of the position, and the margin requirement is generally limited to the initial debit. Conversely, credit spreads require the firm to calculate the maximum potential loss to set the minimum equity requirement. These margin rules are established under Regulation T and subsequent firm-level policies, ensuring that the client possesses the necessary capital to meet their obligations if the market moves against them. Proper documentation and ongoing monitoring of these margin levels are essential duties for the ROP, as they directly impact the firm's liability and overall regulatory compliance posture. I will see you in the next lecture. Welcome back to the course. In this lesson, we will examine the regulatory requirements for opening new accounts and the critical documentation necessary to remain compliant with industry standards. When an individual initiates a relationship with a broker-dealer, the firm is obligated to capture specific data points to form a baseline for regulatory compliance. The new account form must record the customer's full legal name, physical primary residence address, and a valid tax identification number, such as an SSN or ITIN. We also require information regarding the client's occupation, the name and address of their employer, and their citizenship status to ensure eligibility for trading certain assets. While it might seem intuitive that a customer must sign this document, The rules actually state that only a registered principal at the firm must sign the form to approve the account. This principal's signature confirms that the firm has met its obligations to collect all necessary information and that the account opening is appropriate. The client is not required to provide a signature, provided the firm has verified the identity of the person opening the account through external means. Maintaining these records is not merely a procedural formality, but a cornerstone of your fiduciary responsibility. Failure to maintain accurate, updated information on these forms can lead to significant regulatory scrutiny during audits. Firms must adhere to the Know Your Customer Rule, officially known as FINRA Rule 2090, which mandates that every member firm uses reasonable diligence to know and retain the essential facts about every customer. This process goes beyond simple identification and requires an understanding of both financial and non-financial considerations. Financial factors include a client's net worth, annual income, liquid assets, and existing tax bracket, which directly influence their ability to tolerate financial risk. Non-financial information encompasses the client's investment objectives, their time horizon for liquidity needs, and their overall experience with complex financial products. You must categorize these objectives into logical buckets, such as capital growth, where the investor seeks long-term appreciation, current income, where the investor prioritizes cash flow, or stability and preservation of capital. By meticulously documenting these facts, you establish a defensible rationale for any future investment recommendations you might make. This documentation creates an audit trail that proves your professional assessment of the client's unique situation. The Patriot Act introduced the Customer Identification Program, which forces firms to implement rigorous anti-money laundering procedures to prevent criminal use of financial systems. Your firm must verify each customer's identity within a reasonable time frame and maintain records of the verification methods used for at least 5 years after an account is closed. This includes checking names against the Office of Foreign Assets Control list to ensure the client is not a prohibited party. Additionally, Regulation SB requires us to protect the privacy of customer data and provides clients the right to opt out of information sharing with non-affiliated third parties. You must provide a clear privacy notice upon the opening of an account and at least annually thereafter to keep clients informed of their rights. These disclosures are mandatory and intended to prevent the unauthorized exploitation of sensitive client personal identifiers. Managing this data responsibly is directly tied to the firm's reputation and your own professional standing. When dealing with senior or vulnerable investors, FINRA Rule 2165 allows, but does not mandate, firms to request the name of a trusted contact person to protect the client's assets. If you believe a client is experiencing financial exploitation or suffers from a diminished mental capacity, you may place a temporary hold on disbursements of funds from their account. This is a critical safeguarding mechanism designed to prevent the unauthorized depletion of assets during times of crisis. Furthermore, when a customer decides to move their assets to another member firm, we utilize the automated customer account transfer service to expedite the process. The clearing firm has 1 business day to validate the request and must complete the actual transfer of assets within 3 business days. This standardized time frame ensures that clients have timely access to their securities regardless of which financial institution they choose to hold their accounts. Mastering these procedural requirements is essential for your role as a licensed representative. I will see you in the next lecture. Welcome to our deep dive into the various account types and ownership structures you will encounter in your practice. We will now explore the regulatory nuances governing different legal entities, which is vital for passing the exam. Understanding the distinction between ownership types is a fundamental requirement for any registered representative. The most common individual account is straightforward, but things become more nuanced with joint accounts. Joint tenants with rights of survivorship, commonly abbreviated as STROs, dictates that upon the death of one tenant, the entire interest in the account passes to the surviving tenant. In contrast, tenants in common, or TC, provides that each owner has a specified percentage of ownership. When a tenant in a TC account passes away, their portion of the assets is distributed according to their will or estate plan, rather than passing automatically to the other account holder. These distinctions are not just administrative formalities, as they carry significant legal weight regarding who controls the assets and how they are handled in the event of death. When dealing with non-individual entities, such as corporations and partnerships, the documentation must be precise. A corporate account requires a corporate resolution, which is a document signed by the secretary of the corporation that authorizes specific individuals to trade on behalf of the entity. This document explicitly outlines who has the power to open the account and conduct transactions, effectively protecting the broker-dealer from unauthorized trading. Similarly, partnerships require a partnership agreement that lists all partners and identifies those authorized to act on behalf of the partnership as a whole. You must ensure that these documents are current and that the authorized individuals are operating within the scope defined by the governing board or the partnership agreement. Failure to keep these records updated is a regulatory violation that could result in strict disciplinary action. Fiduciary accounts present a different set of challenges, specifically concerning the best interest of the beneficiary. Under the Uniform Gifts to Minors Act or the Uniform Transfers to Minors Act, an account is open for a minor with an adult serving as the custodian. It is critical to remember that the assets in these accounts are the property of the minor, even though the custodian manages the investment decisions. Trust accounts, on the other hand, are governed by a trust instrument that outlines the powers of the trustee and the rights of the beneficiaries. Discretionary accounts allow the representative to make decisions without prior approval for every single trade, but this requires a written power of attorney signed by the client and formal approval by a registered principal. This high level of authority necessitates rigorous oversight to prevent potential conflicts of interest or churning. Margin accounts and advanced trading structures introduce concepts like Regulation T and the definition of a pattern day trader. A margin account allows a customer to borrow money from the broker-dealer to purchase securities, using the account assets as collateral. Regulation T dictates the initial requirement for these loans, which is currently set at 50% of the purchase price for long positions. A pattern day trader is defined as someone who executes 4 or more day trades within a 5 business day period, provided those trades represent a significant portion of the account's total activity. These traders are subject to higher minimum equity requirements, necessitating a minimum of $25,000 to maintain their status. Understanding these thresholds is essential for compliance, especially when advising clients who seek to use leverage for active trading strategies. Finally, we must distinguish between fee-based accounts, often called wrap accounts, and traditional commission-based accounts. A wrap account charges a single, flat fee for investment advice and execution services, which is generally more suitable for clients who trade frequently enough to benefit from the cost structure. Commission-based accounts, however, charge individual fees per transaction, which may be more cost-effective for buy-and-hold investors. Educational savings accounts, such as 529 plans and Coverdell ESAs, serve specific purposes for funding future schooling expenses with distinct tax advantages. While 529 plans offer higher contribution limits and are managed by states, Coverdell ESAs have lower income thresholds and contribution caps for the account holder. Mastery of these structural differences allows you to present suitable recommendations to your clients while remaining within the bounds of FINRA requirements. I will see you in the next installment. Welcome back. Today we address the core of your fiduciary responsibility by mastering investment objectives and suitability analysis. At the heart of the Series 7 examination lies FINRA Rule 2111, which codifies the suitability requirement into 3 distinct obligations. First, there is the reasonable basis suitability, which mandates that a broker must perform sufficient due diligence to understand the security being recommended and form a reasonable belief that it is suitable for at least some investors. Second, the customer-specific suitability requires that the registered representative analyze the individual investor's profile, including their net worth, tax status, investment experience, and time horizon before proposing a specific strategy. Finally, quantitative suitability focuses on recommended transactions that are not necessarily unsuitable in isolation, but represent a pattern of activity that results in excessive turnover, commonly referred to as churning. This rule is not merely a suggestion for ethical conduct. It is a rigid framework that prevents financial loss resulting from neglect or improper alignment of assets. You must interpret these obligations as the bedrock of every recommendation made to a client throughout your professional career. Failing to document this process correctly is often where regulatory scrutiny begins during firm audits or client arbitration cases. Matching investment profiles to specific products requires a granular understanding of asset characteristics and the client's tolerance for liquidity. Illiquid assets like direct participation programs or mini hedge funds demand a long-term capital commitment that is inherently unsuited for short-term savers or those with imminent liquidity needs. Conversely, high-risk assets like small-cap stocks or specific option strategies have no place in a portfolio focused on capital preservation or stability. If a client is in a high marginal tax bracket, your recommendation must shift toward tax-advantaged vehicles, such as municipal bonds, where the interest income is exempt from federal taxation. Wealthy clients often prioritize tax efficiency as much as total return, and the failure to consider their tax bracket can lead to an inefficient portfolio. Always look at the total landscape of the client's finances rather than focusing on a single, isolated product. Planning for the different stages of retirement involves adjusting an asset allocation strategy based on the proximity to the payout phase. Younger investors often prioritize aggressive growth, utilizing small-cap equities or derivatives because they have the time horizon to recover from market volatility. As an investor nears retirement, the portfolio must transition toward income-generating instruments like preferred stocks, utility stocks with dividend histories, or investment-grade bonds. Inflation protection remains a critical concern for most long-term investors, which often necessitates exposure to equities or treasury inflation-protected securities, specifically known as TIPS. If an investor is more concerned with deflationary pressures, fixed income instruments like long-term bonds become more attractive due to the rise in real purchasing power. Capital preservation for those with short-term goals or high stability requirements is typically addressed through treasury bills or money market funds. Seniors and vulnerable investors require a heightened level of caution and oversight due to their specific regulatory profile. Retail communications must be fair, balanced, and not omit material facts, especially when directed toward elderly clients who may rely on these assets for their primary income. You must be vigilant for red flags that indicate a client's lack of understanding or their susceptibility to unsuitable trading activity. Churning is perhaps the most notorious prohibited practice, characterized by excessive trading in accounts solely to generate commissions for the representative. A recommendation that ignores the client's stated goals or attempts to force a product into a portfolio where it does not fit is a fundamental breach of your duty. Your ability to detect these discrepancies between a client's stated needs and the actual portfolio performance is a central testable concept. See you in the next session. Welcome to this module on retirement planning, where we will navigate the complex regulatory framework governing tax-advantaged savings vehicles. You are here because mastering ERISA standards and plan structures is not only a requirement for the exam, but an essential skill for any competent financial professional. When we talk about retirement planning in the context of the Series 7, we must distinguish between qualified and non-qualified plans. A qualified plan such as a 401k or a pension, is subject to the Employee Retirement Income Security Act of 1974, known as ERISA. These plans offer tax-deferred growth for employees and tax deductions for employers, provided they meet strict IRS guidelines regarding non-discrimination and participation. In contrast, non-qualified plans do not meet ERISA requirements and offer no immediate tax deduction for the employer. These are often used for highly compensated executives through deferred compensation arrangements or payroll deduction plans. Because they're not bound by ERISA, they lack the same protection, making them less secure if the employer suffers financial hardship. Understanding this fundamental divide is the first step in assessing the tax efficacy and risk profile for your clients. Employer-sponsored plans are broadly categorized into defined benefit and defined contribution structures. A defined benefit plan, often called a pension, establishes a specific payout for the employee upon retirement, shifting the investment risk entirely to the employer. Conversely, defined contribution plans, such as 401k and 403b plans, define the amount to be invested today, placing the performance risk squarely on the shoulders of the employee. The 403b plan, or tax-sheltered annuity, is specifically designed for public school systems and certain nonprofit organizations. Meanwhile, small businesses often utilize CPIRAs or simple IRAs to provide cost-effective retirement options with lower administrative burdens than a full 401k. Furthermore, self-employed individuals may utilize KEO or HR 10 plans, which allow for significantly higher contribution limits, provided the business owner treats eligible employees with the same percentage of profit sharing as themselves. ERISA serves as the primary legislation governing these private sector plans, focusing heavily on fiduciary standards. A fiduciary must act solely in the interest of the plan participants and their beneficiaries, adhering to the prudent man rule in all investment decisions. Participation requirements under ERISA generally dictate that employees aged 21 and older with at least 1 year of service must be allowed to participate in the plan. Vesting schedules are equally critical, as they determine the point at which an employee gains a non-forfeitable right to the employer's contributions. Cliff vesting requires an employee to be fully vested after a specific number of years, while graded vesting allows for gradual ownership over a set timeline. Failure to uphold these fiduciary duties can lead to severe personal liability for the plan administrators. Individual retirement accounts, or IRAs, provide a different avenue for personal planning, structured either as traditional or Roth. With a traditional IRA, contributions may be tax-deductible depending on the individual's income and participation in an employer-sponsored plan. Roth IRAs, however, are funded with after-tax dollars, meaning qualified distributions are entirely tax-free. Both account types generally prohibit withdrawals before age 59.5, subject to a 10% penalty unless a specific exception applies, such as death, disability, or first-time home purchases. Required minimum distributions, or RMDs, begin at age 73 for traditional IRAs, forcing account holders to liquidate their assets according to the IRS Uniform Life Expectancy tables. Excess contributions to these accounts are penalized at 6% per year until they are corrected. Moving assets between these accounts requires strict adherence to IRS movement protocols to avoid taxable events. A rollover occurs when a participant receives a distribution from a plan and must deposit it into another qualified account within 60 days to maintain its tax advantage status. Only one such rollover is permitted in any 12-month period, a rule that is strictly enforced to prevent misuse of the tax code. On the other hand, a transfer, or trustee-to-trustee transfer, involves moving funds directly from one custodian to another without the assets ever passing through the hands of the account owner. Because the money is never in the owner's possession, there is no limit on the number of transfers one can perform in a given year. Mastering these mechanics is vital for advising clients on asset consolidation without triggering unwanted tax liabilities. I will see you in the next lecture. Welcome to the chapter on margin accounts, where we will demystify the mechanics of leveraging security positions under FINRA and Federal Reserve oversight. We have designed this module to elevate your competency from basic cash trading to the sophisticated world of credit extension, ensuring you master the regulatory nuances required for the Series 7. Regulation T of the Federal Reserve Board governs the extension of credit by broker-dealers to customers, setting the initial requirement at 50% for most securities. When a client opens a margin account, they're effectively borrowing capital to increase their purchasing power, which introduces systemic risk that the regulator seeks to mitigate. Not all securities are eligible for margin. For instance, IPOs are generally not marginable until they have traded in the secondary market for 30 days, and most options contracts must be paid in full since they are wasting assets. We distinguish between long margin, where the client buys securities on credit, and short margin, where the client borrows securities to sell them with the expectation of repurchasing them at a lower price. Monitoring these positions requires an understanding of the relationship between the long market value and the debit balance, which represents the amount the client owes the firm. By subtracting the debit from the market value, we arrive at the equity, which acts as the buffer against market volatility and potential margin calls. In a long margin account, the equity must fluctuate according to predefined maintenance levels, typically set at 25% of the long market value. If the equity drops below this threshold, the broker-dealer issues a maintenance call, often referred to as a house call if the firm's internal requirements are stricter than the regulatory minimums, or a Fed call if the account is undermargined according to Regulation T. Short margin accounts follow a similar, yet inverted, logic wherein the credit balance, consisting of the initial proceeds plus the required deposit, minus the short market value equals equity. The maintenance requirement for short positions is 30%, reflecting the higher risk profile associated with short selling, where the market value can theoretically rise indefinitely. Understanding the special memorandum account is crucial here, as it represents a line of credit generated by excess equity or market appreciation. This buying power can be utilized to purchase additional securities or to meet subsequent margin calls, effectively allowing for double the purchasing power of the existing equity. Operational compliance involves strict adherence to settlement timelines, where Regulation T requires payment within 2 business days of settlement, or T plus 4 days from the trade date. If a client fails to meet these payment obligations, the broker-dealer must liquidate enough of the position to restore compliance, and the account is subsequently restricted. A frozen account prevents the client from making additional purchases unless the full purchase price is on deposit before the trade is executed, a restriction that remains in effect for 90 days. Furthermore, the practice of rehypothecation is strictly limited by regulation to protect the customer from undue risk. A broker-dealer may pledge collateral that secures a customer's debit balance to a bank, but they are only permitted to rehypothecate up to 140% of that debit balance. This limitation prevents excessive leveraging of customer assets and ensures that the firm maintains sufficient control over client securities while facilitating essential clearinghouse operations. See you in the next lecture. Welcome back. In this chapter, we will examine the regulatory requirements surrounding firm communications and how you must handle retail media to maintain compliance. FINRA Rule 2210 classifies communications into 3 distinct categories based on their target audience, which dictates the level of regulatory oversight. Correspondence refers to any written or electronic communication distributed to 25 or fewer retail investors within a 30-day period. Retail communication, by contrast, involves any written or electronic message distributed to more than 25 retail investors within the same time frame. Institutional communication is intended solely for institutional investors, such as banks, insurance companies, or investment advisors, and does not require the same rigorous filing standards as retail material. Understanding the threshold of 25 investors is critical because miscounting the reach of your message can result in a misclassification of your filing obligations. If you send a blast email to 26 people, you have inadvertently engaged in retail communication, thereby triggering stricter scrutiny. Always remember that the nature of the recipient defines the category, not necessarily the internal intent of the firm. The filing requirements with FINRA vary significantly depending on the firm's history and the nature of the communication itself. New member firms are generally required to file their retail communications with FINRA's Advertising Regulation Department at least 10 days prior to first use. This pre-filing requirement acts as a safeguard during the firm's formative period when internal supervision systems are still maturing. For established firms, the rules shift toward post-filing, where retail communications must be filed within 10 business days of first use. Certain types of material, such as those regarding investment companies featuring performance rankings, often require stricter pre-filing even for established brokers. This distinction ensures that high-risk product marketing receives a prophylactic review before it ever reaches the public eye. Mastery of this schedule is essential for passing the exam, as examiners frequently test your ability to distinguish between pre-filing mandates and routine post-filing submissions. Regardless of the category, all communications must adhere to Rule 2210 standards, which emphasize truthfulness, balance, and the absolute absence of guarantees. Every communication must provide a sound basis for evaluating facts and cannot omit material information that would render the message misleading. You are required to balance any highlighted potential gains with a transparent disclosure of the associated risks. Claims, opinions, and forecasts must be based on a reasonable methodology, and you are strictly prohibited from projecting performance with certainty. For example, suggesting that a specific stock will hit a certain price target is a clear violation of the prohibition against guaranteed returns. Regulatory bodies demand that the presentation remains fair and balanced, meaning the font size and visibility of risk disclosures must match those of the performance claims. A balanced presentation ensures that the investor has the full context necessary to make an informed financial decision. Social media presents unique challenges because of its split into static and interactive content. Static content, such as a firm's LinkedIn profile page or a permanent blog post, is considered retail communication and requires principal approval before publication. Interactive content includes real-time communication like instant messages, chat rooms, or Twitter feeds, which are generally exempted from the pre-approval requirement. However, even interactive content must be subject to rigorous ongoing supervision and must be captured for record-keeping purposes. Using professional designations is another area where firms must exercise extreme caution to avoid misleading the public. If you use a designation, it must be legitimate, and you cannot imply that it grants an expertise that the holder does not possess. Ensuring that a designation is not alphabet soup requires firms to monitor their representatives' business cards and email signatures for accuracy. Public appearances, seminars, and research reports have their own specific set of disclosure rules to prevent conflicts of interest. Research reports must explicitly disclose any financial interest the firm or the analyst may have in the subject security to ensure impartiality. During seminars, you must provide a balanced discussion of risks and benefits, and you are held to the same standards of fair dealing as if you were distributing a formal brochure. Record keeping is the backbone of this regulatory framework, with most communication records needing to be retained for 3 years, with the first 2 years in an easily accessible place. Some broader regulatory requirements may extend the retention period to 6 years for specific account documentation and blotters. Maintaining these records enables regulators to trace the flow of information should a customer complaint arise later. An organized firm uses an automated archiving system to ensure that every electronic footprint is stored in accordance with FINRA's strict retention schedule. Principal review acts as the final gatekeeper for compliance, ensuring that all communications align with regulatory standards before they enter the public domain. A designated principal must review and approve all retail communications before they are filed with FINRA or distributed to the public. This individual carries the burden of confirming that the material is not misleading and that it contains all required risk disclosures. For correspondence, while pre-use approval is not always mandated, the firm must still maintain a rigorous system of post-use review to ensure compliance with the quality standards. This hierarchical approach to supervision creates an audit trail that holds both the representative and the supervisor accountable. Without this documented principal approval, a firm is essentially operating without a functional compliance department, exposing itself to significant fines and reputational damage. Consistency in executing these approvals is exactly what regulators look for during their periodic examinations of a broker-dealer. See you in the next lecture. Welcome back to our journey through the fundamental structures of financial markets. In this chapter, we explore the primary markets, where securities are born and capital is raised for issuers. If you're aiming to master the intricacies of the securities industry, understanding the life cycle of a new issue is not just beneficial. It is essential for passing your exam. This section provides the clarity you need on the regulatory framework that governs how corporations move from private entities to publicly traded powerhouses. We will dissect the legal requirements of the Securities Act of 1933, commonly known as the Paper Act, which mandates full and fair disclosure to protect the investing public. By the end of this chapter, you will possess a comprehensive grasp of the registration process and the specific responsibilities of underwriters in bringing new capital to the market. Mastering these concepts provides the foundation for evaluating almost any corporate security you will encounter on the Series 7. The Securities Act of 1933 serves as the bedrock of investor protection by requiring issuers to file a registration statement with the SEC before offering securities to the public. This process typically transitions through three distinct phases: the pre-filing period, the cooling-off period, and the final effective date. During the pre-filing period, an issuer prepares the registration statement, and no offers to sell or solicitations of interest are permitted by law. Once filed, the cooling-off period begins, lasting a minimum of 20 days, during which the SEC reviews the filing for completeness and accuracy. During this time, the syndicate may distribute a preliminary prospectus, known as a red herring, to gather indications of interest from potential investors. It is vital to remember that the red herring does not contain the final offering price or the effective date, marking it as an incomplete disclosure document. Once the SEC clears the registration, the effective date is reached, allowing the final prospectus to be delivered and the sale of securities to become legally binding. Underwriters play a pivotal role in this life cycle, often functioning through an underwriting syndicate to distribute the risk and the shares of a new issue. The syndicate manager acts as the primary contact, coordinating the stabilization efforts if the secondary market price falls below the offering price. In a firm commitment underwriting, the syndicate assumes the full financial risk by purchasing the entire issue from the issuer and reselling it to the public, guaranteeing the issuer a specific amount of capital. Conversely, in a best efforts arrangement, the underwriters act merely as agents, agreeing to sell as much of the issue as possible without committing their own capital to cover unsold portions. Variations like all or none or minimax contingencies are also common. These require the deal to be canceled unless a specific minimum amount of capital is successfully raised within the set time frame. Stabilization, though technically market manipulation, is allowed under narrow SEC rules as a way for the manager to support the price of a new issue during the immediate post-offering period. Beyond standard IPOs, issuers often utilize specific regulatory exemptions to raise capital without the full burden of a complete public registration. Rule 144 governs the resale of restricted and control stock, requiring strict adherence to volume limits and holding periods to ensure that private sales do not circumvent the disclosure requirements of the 1933 Act. For institutional trading, Rule 144 allows for the sale of restricted securities to qualified institutional buyers, known as QIBs, facilitating a liquid, though private, secondary market. Regulation S provides an exclusion for securities offered and sold outside the United States, acknowledging that transactions occurring entirely offshore fall outside the SEC's primary jurisdiction. Meanwhile, Regulation D remains a common path for private placements, allowing issuers to sell securities directly to accredited investors without full registration, provided they meet specific criteria regarding the number and nature of participants. These instruments allow for specialized capital formation, and understanding the scope of each is a frequent requirement when assessing the legality of market transactions. Corporate issuers often utilize shelf registration under Rule 415, which allows an issuer to register a block of securities for sale over a period of up to 3 years. This flexibility enables companies to tap into the market at the most opportune moments without refiling their paperwork each time they decide to issue more equity or debt. Another critical feature in modern IPOs is the green shoe clause, formerly known as an overallotment option. This provision permits the syndicate to sell more shares than were originally registered if demand is exceptionally high, thereby providing flexibility to stabilize the price during early trading. When you examine these mechanisms, focus on how they balance the company's need for capital accessibility with the regulatory demands for transparency. The interplay between the issuer, the underwriter, and the regulatory oversight of the Securities Act defines the orderly function of our capital markets. See you in the next lecture. Welcome back. In this chapter, we will explore the mechanisms of secondary market trading, focusing on how exchanges operate and the regulatory environment governing these transactions. The Securities Exchange Act of 1934, often called the People Act, stands as the foundation of our secondary market regulation, designed to ensure transparency and fairness in the trading of existing securities. Unlike the primary market where new issues are sold, the secondary market is where investors trade among themselves, requiring robust infrastructure to maintain price discovery. We differentiate between auction markets, such as the New York Stock Exchange, where prices are determined by competitive bidding in a centralized location, and negotiated markets, like the NASDAQ, where market makers facilitate execution. In an auction market, the designated market maker, or DMM, acts as a primary participant tasked with maintaining a fair and orderly market by facilitating trading in assigned securities. Conversely, the NASDAQ utilizes a network of competing market makers who provide quotes and inject necessary liquidity into the system to handle investor interest. This fundamental distinction in price determination drives how orders are routed and executed daily. Understanding the nature of order types is essential for effectively managing trading risk and achieving specific execution objectives. A market order requests immediate execution at the best available current price, prioritizing speed over price certainty, whereas a limit order provides price control by executing only at a specified level or better. We then move into stop orders, which become market orders once a specific price, known as the stop price, is touched during trading. A buy stop is typically used to protect a short position or establish a new long position if a security breaks through resistance, while a sell stop acts as a safeguard to protect profits or limit losses on long positions. Finally, a stop limit order combines these concepts, triggered by a stop price but constrained by a limit price to prevent unfavorable execution prices. These tools allow investors to govern their capital exposure with varying degrees of precision. As trading occurs, transparency is maintained by the consolidated tape, which streams real-time data regarding volume and price across both exchange-listed and over-the-counter securities. Market participants look specifically at the bid-ask spread, which is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. This spread represents the cost of liquidity, and generally, a tighter spread indicates a highly liquid and efficient market. Beyond traditional exchanges, electronic communication networks, or ECNs, provide automated systems that match buy and sell orders directly, often increasing speed and lowering transaction costs. We also see the use of dark pools, which are private trading venues that allow institutional investors to execute large block trades without immediately revealing their intentions to the broader market. These venues operate under SEC oversight to ensure that they do not undermine the overall stability or fairness of the national market system. The regulatory landscape is anchored by the SEC, which maintains broad jurisdiction, while FINRA oversees broker-dealer conduct, and the MSRB manages the unique rules surrounding municipal securities. To prevent extreme volatility, exchanges implement circuit breakers, often described as trading halts, which pause activity across the entire market during specific price declines. A Level 1 halt triggers at a 7% decline, Level 2 at 13%, and Level 3 at 20%, providing necessary cooling-off periods to temper investor panic. Short selling, the act of selling borrowed securities in anticipation of a price drop, is strictly governed by Regulation SHO. This regulation enforces a locate requirement, meaning a broker-dealer must have reasonable grounds to believe the security can be borrowed and delivered by the settlement date before executing a short sale. These compliance measures are critical to ensuring market integrity and preventing systemic abuse. Finalizing a trade requires a standardized settlement process, and currently, the industry operates on a T+2 cycle, meaning trades settle 2 business days after the execution date. In this standard framework, legal title and payment change hands at the end of this period, allowing the clearing corporation to net out positions and manage risk. Conversely, cash settlement is a specialized arrangement where the transaction settles on the same day the trade is executed, rather than the standard 2-day period. This is often required for specific delivery needs or unique client circumstances, though it is the exception rather than the rule. Understanding this timeline is vital for managing cash flow and ensuring that securities are available when the settlement obligation becomes due. See you in the next lecture. Welcome to our deep dive into the regulatory expectations governing your conduct as a registered representative. We will examine the specific rules that maintain market integrity and protect public investors from unethical broker actions. The foundation of our regulatory framework is the comprehensive anti-fraud provision, which applies to all securities transactions regardless of whether a security is exempt from registration. You must understand that the Securities Exchange Act of 1934 prohibits any act or omission that results in manipulation or deception, including the use of any manipulative or deceptive device in connection with the purchase or sale of any security. This is a broad mandate that empowers the SEC to pursue actors who distort market prices or conceal material facts. When we talk about insider trading, we refer to the Insider Trading and Securities Fraud Enforcement Act of 1988, which imposes severe penalties on those who possess and trade on material non-public information. This act distinguishes between the tipper, who provides the information, and the tippee, who receives it, with both facing potential civil and criminal liability. The most notable consequence under this act is the potential for treble damages, meaning the violator can be penalized up to 3 times the profit gained or loss avoided. These rules serve as the guardrails for your professional behavior, ensuring that you do not gain an unfair advantage through non-public disclosures. Market manipulation takes various forms, each designed to create a false impression of trading volume or price interest. A wash sale occurs when an investor enters into a purchase and sale of the same security at nearly the same time, resulting in no change to their beneficial ownership. Similarly, painting the tape involves a series of transactions that are specifically intended to create the illusion of widespread market activity. Matched orders are a more coordinated effort where parties buy and sell identical securities at the same time to create a false appearance of volume. You must also avoid front-running, which describes the practice of placing a personal trade ahead of a customer's pending block order, thereby exploiting the price movement caused by the customer's activity. Interpositioning is another prohibited practice wherein a broker introduces a third party into a transaction between a customer and the best available market, ultimately decreasing the customer's net proceeds or increasing their costs. Lastly, backing away from a quote refers to the failure of a market maker to honor the price they have explicitly published to the public. Operational compliance extends into how you handle client accounts and personal business interests. Free riding occurs in a cash account when a customer buys securities and then sells them before paying for the purchase, effectively using the proceeds from the subsequent sale to fund the initial obligation. Commingling of funds is strictly prohibited, meaning you're never allowed to mix customer assets with your own or the firm's general operating assets. In the realm of pricing, capping and pegging are forms of manipulation used to influence the price of security. Capping tries to keep a price below a certain level, while pegging aims to keep it above a specific point. Selling away, or private securities transactions, requires explicit written approval from your firm before you engage in any securities activity outside the scope of your employment. Similarly, you must notify your firm of any outside business activities, such as serving as an officer or advisor to a separate company, even if that work is not directly related to securities. Professional ethics also govern the scope of benefits you may provide or receive in the context of your business relationships. The FINRA rule regarding gifts and gratuities dictates that you cannot provide gifts to any person associated with another member firm in excess of $100 per person per year. This limit is designed to prevent the appearance of influence peddling or the purchasing of business through non-professional channels. Furthermore, excessive trading or churning is a violation characterized by trading that is inconsistent with a client's objectives and, instead, is executed primarily to generate commissions. To identify churning, firms look for indicators like high portfolio turnover rates, frequent changes in assets, and a documented history of the customer's stated investment goals being ignored. You are also subject to strict limits on borrowing from or lending to customers, and you generally may only do so if the customer is an immediate family member or a financial institution engaged in the lending business. See you in the next lecture. Welcome back. In this chapter, we will master the complexities of anti-money laundering regulations to ensure you are fully prepared for the most challenging compliance questions on the exam. Money laundering is fundamentally the process of making illegally obtained funds appear legitimate, a practice that the financial industry is rigorously mandated to intercept. To understand this structure, we look at the three distinct stages: placement, layering, and integration. Placement is the point at which illicit funds are first introduced into the financial system, often through cash deposits or other high-risk entry points. Layering then acts as the second stage, involving a sequence of complex financial transactions specifically designed to distance the fund from their original criminal source. This often includes shifting money between multiple accounts or across various jurisdictions to create a paper trail that is intentionally difficult to follow. Integration completes the cycle, as the funds are reintroduced into the economy as apparently legitimate assets, such as purchasing real estate or investing in securities. Recognizing these stages is vital for the Series 7 level because you must identify the subtle patterns that indicate someone is attempting to bypass the standard banking infrastructure. The regulatory framework governing these activities is anchored by the Bank Secrecy Act, which imposes specific reporting requirements on broker-dealers to maintain the integrity of the U.S. financial system. Financial institutions must identify and track movements of cash through the Currency Transaction Report, commonly known as the CTR. A CTR must be filed whenever a customer engages in a cash transaction exceeding $10,000 within a single business day. It is a common subject of examination testing to remember that the filing deadline for this report is 15 days after the transaction. While the CTR handles the reporting of significant cash volumes, the Suspicious Activity Report, or SAR, deals with transactions that lack any clear business or lawful purpose. Firms are mandated to file a SAR for any detected activity that they know or suspect involves funds derived from illegal conduct or is designed to evade reach of the Bank Secrecy Act. The filing deadline for a SAR is 30 days from the date of the initial detection, and you must note that the existence of this report is strictly confidential. Employees are prohibited from disclosing that a SAR has been filed to the client, a policy known as a non-disclosure requirement. Because the risk of financial crime is systemic, firms are required to implement robust internal compliance programs that go beyond mere paperwork. Every broker-dealer must designate an anti-money laundering compliance officer who is responsible for the firm's adherence to all relevant Treasury regulations. This individual serves as the central point of contact for law enforcement agencies and ensures that the firm's written supervisory procedures remain updated with current legal standards. Furthermore, the law mandates annual independent testing of these AML programs to ensure their consistent effectiveness. This testing must be conducted by someone other than the AML compliance officer, ensuring an objective review of the firm's practices. These programs are not optional. They are a prerequisite for maintaining broker-dealer registration. Failure to provide this oversight leaves the firm vulnerable to significant regulatory sanctions, including heavy fines or, in extreme cases, the revocation of its operating license. In addition to domestic concerns, firms must actively screen the global financial network to prevent transactions with entities that threaten national security. The Office of Foreign Assets Control, known as OFAC, maintains a list of specially designated nationals and blocked persons. Broker-dealers are required to check all new accounts and transactions against this SDN list, which identifies terrorists, narcotics traffickers, and other individuals or entities sanctioned by the government. If a firm identifies a match, they must block the account and report the activity to the federal authorities immediately. Failing to maintain this watch list leads to severe consequences for the firm and the individual associated representative. Because these regulations are part of federal law, violations often result in criminal prosecution, which can lead to substantial prison sentences for employees who are found liable for facilitating financial crime. This necessitates a proactive stance on the part of every registered representative to understand the red flags of money laundering. Identifying suspicious activity often starts with observing behavior that deviates from standard client profiles, regardless of the size of the transaction. A primary red flag is a customer who shows a distinct lack of concern for investment risks, transaction costs, or commissions. You should be alert to a client who insists on frequent deposits of small, structured amounts just under the $10,000 reporting threshold, a classic indicator of structuring designed to avoid CTR requirements. Additionally, look for unusual wire transfer activity, particularly when money is frequently moved between accounts in jurisdictions that provide high levels of banking secrecy. Other signs include account activity that does not match the client's stated financial goals or employment history. An individual who lacks any logical reason for holding a specific account structure or who is reluctant to provide requested documentation is an immediate trigger for further investigation. Your role during the exam is to recognize that these markers represent a high risk of money laundering and must be reported through the appropriate internal channels. I will see you in the next lecture. Welcome to the module on regulatory frameworks, where we navigate the oversight mechanisms that govern the securities industry. You will master the complex roles of regulatory bodies and the registration requirements that are essential for any professional in this field. The primary federal regulator of the United States securities industry is the Securities and Exchange Commission, an agency tasked with maintaining fair, orderly, and efficient markets. While the SEC sets the broad rules, it delegates significant rulemaking and enforcement authority to self-regulatory organizations, or SROs. The Financial Industry Regulatory Authority, known as FINRA, operates as the primary SRO for broker-dealers, while entities like the Chicago Board Options Exchange oversee specific market segments. The Municipal Securities Rulemaking Board occupies a unique position by formulating regulations for those who deal in municipal securities. Crucially, the MSRB lacks its own enforcement arm and relies on other agencies, such as FINRA or the SEC, to ensure broker-dealers comply with its established rules. Understanding this hierarchy is the first step in recognizing how an individual firm is held accountable to both federal mandates and industry-specific standards. Registration for those working in the industry begins with the filing of Form U-4, which serves as the uniform application for securities industry registration or transfer. This document requires comprehensive personal information, including 10 years of employment history and detailed residential data. A critical component of this process is the fingerprinting requirement, which applies to almost all individuals associated with a member firm to ensure thorough background checks through the FBI. When an individual leaves a firm, the broker-dealer must file a Form U-5 within 30 days to officially notify regulators of the termination and provide the reason for separation. Regulators also keep a watchful eye on potential statutory disqualification triggers, such as felony convictions or specific securities-related misdemeanors from the past 10 years. If a person is subject to such disqualification, their ability to remain registered or even enter the industry is severely compromised, acting as a structural barrier to protect investors. Beyond initial entry, compliance is a continuous process maintained through the continuing education program, which consists of two distinct components. The regulatory element is a computer-based training program developed by FINRA that registered individuals must complete at specific intervals, typically on the second anniversary of registration and every 3 years thereafter. The firm element, alternatively, is the responsibility of each individual broker-dealer and must be tailored to the business needs and practices of that specific firm. It focuses on the practical application of rules to the firm's specific activities and must be updated annually based on a formal needs analysis. Additionally, broker-dealers must comply with blue sky laws, also known as the Uniform Securities Act, which requires registration of both the firm and its representatives at the state level. This ensures that even firms operating nationally must respect the jurisdiction of the individual states where their customers reside. Regulatory conduct also extends to how firms manage their interactions and disputes with the public, specifically regarding customer complaints. Firms have a strict obligation to report certain customer complaints to FINRA, especially those alleging theft, misappropriation of funds, or forgery, which are considered reportable events. When disputes arise between a firm and a customer, they are often settled through arbitration, a mandatory process for most FINRA-regulated entities. Unlike litigation, an arbitration award is final and binding with very limited avenues for appeal, making it a powerful tool for industry dispute resolution. Mediation, on the other hand, is a voluntary process where a neutral third party helps the parties reach a mutually agreeable settlement. Should a broker-dealer fail, the Securities Investor Protection Corporation, or SIPC, provides insurance coverage for customer assets up to certain limits. It is vital to note that SIPC is not the same as FDIC. While FDIC protects banking deposits, SIPC protects customer cash and securities held at failing brokerage firms. I look forward to discussing how these regulatory structures influence daily trading operations in the following lesson. Welcome back. In this lesson, we will examine the mechanics of how a trade moves from an initial order to final settlement, covering the technical processes regulated by FINRA. The life cycle of a trade begins the moment a customer enters an order, triggering a sequence of events designed to ensure the integrity of the market. Order entry is followed by execution, where the purchase or sale is locked in at a specific price, typically reported through the consolidated tape. Once executed, the transaction moves into the clearing phase, which is handled primarily by the National Securities Clearing Corporation. The NSCC acts as a central counterparty, netting out trades to reduce the number of physical or book entry movements required between broker-dealers. Simultaneously, the depository trust company manages the actual custody and movement of securities, facilitating book entry transfers that eliminate the need for physical certificates in most modern transactions. For a broker-dealer to participate in this ecosystem, they must adhere strictly to the net capital rule, which mandates that firms maintain a sufficient amount of liquid assets to meet their obligations. These capital requirements are non-negotiable safeguards intended to protect customers from the risk of firm insolvency during the settlement cycle. Settlement represents the final stage of the trade life cycle, where the transfer of ownership occurs in exchange for payment. For most securities, the standard settlement cycle is T+1, meaning the trade must settle by the end of the first business day following the trade date. In specific institutional scenarios, we utilize delivery versus payment or receipt versus payment accounts, which are designed to ensure that the delivery of securities is strictly contingent upon the receipt of payment. This mechanism minimizes the risk of non-delivery for institutions that handle high-volume transactions, effectively acting as a safeguard for both the buyer and the seller. If a trade involves physical certificates, we must also consider the rules of good delivery, which dictate that securities must be in a transferable form, properly endorsed, and in acceptable denominations. An endorsement on a certificate or a separate stock power must be signed exactly as the name appears on the face of the security to ensure validity. Calculating the financial aspects of a trade often involves determining accrued interest, which is the interest accumulated on a bond since the last coupon payment. For corporate and municipal bonds, the industry standard is the 30/360-day count convention, meaning we assume every month has 30 days and every year has 360 days. Conversely, United States government bonds utilize an actual/actual day count convention based on the specific number of days in the current month and year. Understanding these distinctions is critical for both the buyer and the seller because the price of the bond on the secondary market must be adjusted to account for the interest earned but not yet paid. Furthermore, we must address the adjustment of open orders when a corporation declares a dividend. Under the Bliss rule, open orders such as by limits or sell stops are generally reduced by the amount of the dividend on the ex-dividend date, unless the customer specifies that the order should not be adjusted. Compliance and administrative rigor follow the settlement process, primarily through the delivery of trade confirmations. A broker-dealer is required to furnish a trade confirmation to the customer either at or before the completion of the transaction, which typically aligns with the settlement date. This document serves as the formal record of the trade, detailing the security, price, quantity, and applicable fees. If a firm identifies an error in the trade report, or if a counterparty denies that a trade took place, the firm must issue a DK notice or don't know notice. This formal notification essentially alerts the other party that the firm has no record of the trade or disagrees with the terms provided in the initial confirmation. Efficient resolution of these discrepancies is essential to maintain accurate books and records as mandated by SEC and FINRA regulations regarding the audit trail of market activity. See you in our next session. Welcome to the final stage of our journey, where we consolidate your knowledge and refine your approach to the examination. In this session, we will synthesize the core domains of the Series 7 and establish a concrete strategy for your success. When we look back at the breadth of the material, the difficulty rarely lies in a single obscure fact, but rather in the synthesis of multiple concepts. The most prominent area remains Function 3, which encompasses the supervision of accounts and trade activities, requiring a firm grasp on the regulatory framework governing suitability and communication. You should approach your review by mapping these regulatory requirements onto the specific products we have discussed, such as municipal bonds and complex option strategies. It is essential to remember that even within this final review, the focus must remain on the client's best interest as defined by FINRA standards. The objective is to identify how these rules interact in a practical scenario rather than simply memorizing definitions. When you encounter high-weight topics, prioritize the underlying ethical principles that dictate how a registered representative handles conflict or oversight. Efficiency in this section relies on your ability to quickly filter through distractor information to identify the primary regulatory trigger. Mathematics can often feel like a point of friction, but it is purely mechanical if you maintain a consistent mental model. For options, the break-even points are fixed by the relationship between the strike price and the premium, regardless of whether you're dealing with a simple long call or a complex spread. Always remember the tax equivalent yield formula, which allows you to compare municipal bonds against taxable equivalents. It is essentially a ratio calculation of the tax-free yield divided by the inverse of the investor's tax bracket. When addressing margin equity, focus on the market value minus the debit balance, ensuring you account for the varying requirements of long versus short positions. Do not attempt to derive these formulas from scratch during the exam, as doing so introduces unnecessary cognitive fatigue. Keep these formulas locked in your repertoire so that you can apply them instantly when a question provides the necessary variables. Practicing the application of these formulas under pressure is the only way to ensure they become second nature. Strategy during the assessment itself is just as critical as the knowledge you possess, starting with your pace. You are allotted 1.8 minutes per question on average, which means you must avoid the trap of spending 5 minutes on a single difficult item. If a question feels intractable, categorize the potential answers, make the most informed choice possible, and move forward without hesitation. When you encounter questions structured with Roman numerals, always evaluate the statements one by one before looking at the choices, as this prevents confirmation bias from clouding your logic. Similarly, watch out for the word except in questions, as it drastically reverses the logic required to reach the correct answer. You must read every word of the question stem because FINRA frequently includes small qualifiers that change the entire context of the inquiry. The correct answer in a most appropriate question is defined by the hierarchy of regulatory importance, not by your personal intuition or preference. Preparation extends beyond the intellectual, encompassing the logistical realities of testing at a prometric center. Ensure you are familiar with the list of prohibited items, as even minor infractions can jeopardize your testing experience or your eligibility to retake the exam. You will be provided with scratch paper or a digital whiteboarding tool, which you should use immediately upon starting to jot down those critical formulas we discussed earlier. After you conclude the exam, the feedback process is immediate, and you must remain cognizant that your performance is subject to final review by FINRA. Before you walk into that center, verify that your identification meets all required standards to avoid any administrative delays. Treat the entire event with the same professional rigor you would apply to managing a client's portfolio. Your goal is to enter the room with a clear mind and a structured plan that minimizes the influence of nerves. As you transition into your role as a licensed professional, remember that your registration is not merely a credential, but a mandate for ethical conduct. The rules you have studied are the floor, not the ceiling for the standards expected of you in the financial industry. Maintain this habit of questioning the intent and the compliance implications of every trade or strategy you present to a client. Ethics are easy to uphold when business is straightforward, but they are tested during market volatility and individual conflicts of interest. Always prioritize transparency, full disclosure, and the objective analysis of risk for the people relying on your advice. As a general securities representative, your reputation is the most valuable asset you will manage, and it begins with the integrity you display in your daily operations. Carry this commitment to service forward as you finalize your study routine and prepare to demonstrate your competence. I wish you the very best of luck on your examination.